how to select projects in a portfolio there. So we are going to discuss today with examples how you should select projects based on business case to make sure you are selecting the best portfolio for your company there. Oh, my name is Guilherme and I'm a project management expert. I help professionals and company, of course, to succeed with project management and to deliver more value there. And before I forget, of course, make sure you like and share this video so it can get to more people, but also make sure you follow me for more content. So here in the screen, my screen, you see a question there, uh, which is very simple. How you have two project options, project A with a gross margin of 35% and project B with a gross margin of 30%. Which one would you select? Well, if you are like most or if you are a lot of people, you just jump in and say, I'm going to go for project A because it has 35% gross margin. Here's something important that you need to understand. Your gross margin doesn't necessarily say everything that you need to know about a project investment there. What do I mean by that? Well, you can even have a high gross margin there, but the gross margins to sell one product or maybe one service does not say much about the long term, does not say anything about initial investments and so on. And if you are wondering what would be the right question, well, the right question would be, I need more information to be able to conclude in something there. So if you are jumping the answer A, no worries, I tricked you. So that's also something that you need to understand when you are talking about decision making and when you are talking those type of numbers. And to do that, I need to make a big parenthesis here to explain a content here from Daniel Kahneman here and to talk about a bit how our brain works, and that's why I tricked you and answer the project A. Basically, this guy, Daniel Kahneman, he is a very famous researcher. He has a very interesting book that I'm showing here called Think Fast and Slow. Basically, in the book, he explained that the basically how our brain works. We have two systems. One is called System 1, and the other one is called System 2. What's the difference between those two systems? Before saying the difference of those two systems, why something like that exists? Because if you think about 10,000 years ago, where we would live in caves or in an open area, we would need first, the brain is the part of your body that consumes most energy. So, of course, the brain needs to find a way to save energy there. Otherwise, if you go for deep thinking and everything else, you will not have energy. And considering a scenario first that you have very limited food, like 10,000 years ago, and also a lot of different scenarios where you need fast decision making. Like if you are walking in the forest and you see a wolf, you cannot think of start reasoning about that. You need to react fast because that's what's important. And that's basically what system 1 and system 2 do. System 1 thinks fast, just like it's kind of unconscious, it's automatically, it's effortless. For example, your system 1 just control your breathing. You don't need to think, I'm going to breathe. System 1 just take care of that, keeps things running. If you get a question that should be straightforward, like what is 1 plus 1? Yeah, you don't need to think, ratiocinate, or you don't need to make math to do that. You just answer automatically. It's 2. This is the kind of stuff that your system 1 takes care of. So it does not have like self-awareness. So you can say the system 1 is not thinking about emotional intelligence, what would be a complex decision. It should be used for simple decision and of course to make sure our bodies are running. What is the system 2 is about? Well, this system 2 does only 2% of the thinking because it's the one that we really need to focus, to pay attention, to have awareness, to deliberate. So we that control logical, skeptical. So you are going to look for something, you're going to look for reasoning, you're going to think positive and negative things to do it. So what happened in reality? When I ask you the question, which project you should choose, 35% gross margin or 30% gross margin, your system 1 just fast, did not think, effortless, just say 35%, or for at least for a lot of people. But why I'm telling you that? And that's, of course, how is that relevant in a scenario that you're selecting projects for a company? First, if you are aware that you have two ways of thinking, you can double check the type of decision that you're making. For example, instead of just jumping onto our solution as an impulse, because it's unconscious, it's automatic, it's effortless, you need to think about, okay, what we are trying to do here. So you need to pay attention, conscious attention there to make the decision. And this matters a lot. A lot of times when you're executing projects, you are going to see system one and system two. They're always there. System one does 98% of our thinking. And for a lot of decisions, if you take the decision without thinking it, or that the way it goes with the system one unconscious there, very often you're going to select the wrong path for your team or for your project and for your company. If I go back to the example here, now you know that you need more information about project A and project B. So if I ask you the different type of question, project A has 35% gross margin with an NPV of $500,000. Project B has a 30% gross margin with an NPV of $1 million. Which one would you choose? Well, if you are like most people, you already select project B with a higher NPV. NPV, if you do not know, stands for net present value. I'm not going to explain this in the details. I have other video or other content explaining that, but NPV stands for net present value. So you are going to select for the higher NPV, right? Here's the thing again. If you select the project B, the right answer again would be you need more information to take a decision. In this case, probably you are already not using your system one, because when I brought to your attention, your conscious looking for something how you can do that. But and if you select the project B, don't worry, you are like operating as probably a big part of the companies there. They select projects only thinking about the NPV there. Why it's important, why it's that matter? Because the NPV, it's a very important information because it shows if the company is creating value or destroying value. If you have, of course, a positive NPV, it's already a good thing. But and if, of course, in theory, you want to have the highest NPV possible. That's why a lot of companies, they go for project B. However, the NPV does not say anything about initial investment. So let's say I'm going to make an exaggeration here just to make the point clear. Let's say that for this project here, the company needs to invest, I don't know, 300K for the project A, initial investment. They are going to invest engineering hours, development hours to launch a product, build prototypes, or whatever kind of development that you're going to have there. And what about project B? If I say that the project B, the initial investment here is 10 million. Well, those projects, they are different. The initial investment here is much higher than this one. And then also that means that you have different risk level there. You can imagine that if you need, and if I make an analogy here, if you say you're going to buy something that costs for you, I don't know, $50. And if you say, I'm going to buy, I don't know, a t-shirt of $50. Okay, it's not a cheap t-shirt in my view, but anyway, you can live with that. If you say if you don't like it, if you don't use a lot, okay, it's only $50. But if I'm making an analogy here, of course, exaggerating a bit, if you're going to buy a t-shirt of $5,000, 5K USD, well, you really want to make sure that you really like that one and you're really going to use that. Otherwise, you're not going to put, or if you're like most of people, you're not going to put the money on something like that, and you just go for this one. That gives you the benefit that you're looking for, and it's a more reasonable range with a lower risk that in the end you're going to waste your money. And even if you waste your money, it's $50 versus 5K. And of course, this is a stupid analogy with the t-shirt, but you can look for different things for investment for a car, for a watch, and for everything else. Higher the investment that you need to make, higher the risk. And if we put that in a financial scenario, like you're investing money in a stock, for example, if you say, I'm going to invest $100 in the stock market. If you say, okay, what if you lose the money, or you're going to invest $100 on Bitcoin? Okay, if you lose the money, yeah, it's $100. You can live with that. It's not going to be a deal breaker into your life. But if I tell you now you're going to invest 2000K USD in Bitcoin, well, that's already a different decision. Although you can still live with the if you completely lose the 2K, you're going to consider and think much more what kind of risk you're going to expose than if you're going to invest 100K. And I can keep going if you invest $1,000 or if you invest $100,000. Higher the investment, higher the consideration that you're going to make. Usually higher the risk that you are exposed. What risk we are exposed? Well, if you lose the investment, if it's a bad investment, here you lose $1,000 and here you lose $100,000. So the impact here is much higher. And that's what risk is about. And that's what's not captured in the NPV. That's why I have a third question to help you with the selection of your project. If your project A has a 35% gross margin, NPV of 500K, and a ROI of 30%, project B has a gross margin of 30%, NPV of 1 million, and a ROI of 10%. Then things start to be more tricky. For me, if I would have to select only based on the financial information, I would go for project A. And you say, okay, project B, you get more money, you get 1 million, but of course, you also get a bit more risk. Here, it's a better investment of capital. If all companies, they have limited amount of resource, money, it's a resource. And if you say, it looks like a bit better investment for me to get 30% and also half of million here, then get 10% an investment here and get or 1 million here. Why? Because if things go wrong with a ROI of 10%, there's a chance also that you are going to end up in a negative scenario, that you're going to lose money. With 30%, you have more safety. It's also about risk management. That will depend on how the organization is willing to take risk, how they are willing to be exposed to risk, what kind of risk that you have with the project, how is the project strategic alignment with the company. But what I want you to give the information here, and that's why I created this. Very often you see people jumping on in this question here without thinking. So you already know that you have system 1 and system 2. Then every time you get something that's important, make sure that the system 2 is in place. So focus, pay your attention, be conscious there, and that's how you're going to avoid jumping into those type of questions. Second, I want you to make sure that you understand that NPV, although it's a very important metric, NPV by itself does not say anything about your project. And third, I want to make sure that you understand that with the NPV, you also have a ROI that can influence there, because the ROI also say what's the size of the investment that you're making. If you say, I need to invest $100 to get $10,000, that's a different discussion. But if you say, I need to invest $9,500 to get $10,000, then of course, you're going to make different types of consideration while selecting investment. And now, if you are staying with me here, I have a bonus question for you. And what if I tell you in that scenario here that the project A, so let me write down the different scenario here to help you think. Because if you're already in this situation, you're already better than most companies, but let me give you something extra here. What if the project A was done by the team 1, or the business case and how they create the scenarios was the team 1? They were very conservative. They used a WACC, or a discount rate, for the business case of 20%. They use the minimum expected price, minimum price, and they used a pessimistic scenario for selling. Let's assume that they are selling a product here. They use a very pessimistic scenario, meaning that the number of products that they are going to sell is the minimum they estimate there. So minimum volumes there. But if I tell you that the project 2, the team 2, create project B, and they really want this project to be approved because they think it's a good idea, so they created a very positive scenario or a very optimistic scenario there. They use a WACC of 5%. They use the max price that they could get from the market to make the business case scenario, and they use the max volume that they expect to sell it to showcase this scenario here. Why I'm telling you that? Because this is a very important part that a lot of organizations they forget to think about it. When you're comparing different things, you want to make sure that you are making a fair comparison. What do I mean by that? Are you comparing apples to apples? Because in this case, it looks like an apple, and this is here, it's a banana. And my drawings are horrible, but why those are quite different scenarios. You cannot compare a worst case scenario with a best case scenario. They are always to make a decision, or at least for different projects. You can compare a worst best case scenario for the same project, but if you're comparing for different projects, what you're doing there does not make sense. Because because likely this scenario here for the project A, it's much better, and it's not even comparable with the scenario for the project B. So if you're already here, you're already ahead of most of companies, but if you want to be a top company, they're the best in class company, they make sure that they have solid business case to select projects, meaning that they also understand what kind of assumptions there are underlying those business case, like critical assumptions like discount rate, pricing, volumes, initial investment. Those are critical there to select something that's useful for you there. If you are looking to develop I hope you like the content. And if you have questions, just feel free to ask the questions. Send me a direct message there on my Instagram. I always reply everybody there. And if you want to further develop the project management skills, your project management skills, or your company project management skills, just send me a message. Let's chat about that one. Thanks for staying with me. Don't forget to follow for more content, and see you soon. Bye.